Bitcoin is like digital money that lives on the internet and is a kind of money that isn't controlled by any government. Many people argue about whether it's a good thing or a scam. We're going to look at both sides of the argument and understand why some people think it's great and why some say it's not trustworthy. So stay with us to discover if Bitcoin is the future, something to be careful about, or whether Bitcoin is a legitimate digital asset or just a scam. The historical background of Bitcoin is a fascinating journey that began with the invention of this digital currency. In 2009, an anonymous person or group using the pseudonym Satoshi Nakamoto introduced Bitcoin as a decentralized peer-to-peer electronic cash system. To this day, Satoshi's true identity remains a mystery, adding to the intrigue. Bitcoin's early days were marked by limited awareness, but it gained momentum as people recognized its potential. It became widely used for various online transactions, and its unique feature, the blockchain, played a pivotal role. The blockchain is a decentralized ledger that records all Bitcoin transactions, ensuring transparency and security. Its development marked a turning point in the world of cryptocurrencies, with applications beyond just digital money. As Bitcoin's popularity grew, so did its value and ecosystem, with exchanges and businesses adopting it. Over time, Bitcoin established itself as a groundbreaking innovation, impacting the financial world and inspiring the creation of thousands of other cryptocurrencies. Bitcoin, a digital currency, offers several advantages that make it a unique and appealing financial tool. In simple terms, these benefits can be grouped into four key categories: decentralization, security, investment opportunities, and financial inclusion. One of the main benefits of Bitcoin is decentralization. This means that it operates without a central authority, like a government or a bank. Instead, it's maintained by a network of computers, often referred to as nodes. This eliminates intermediaries such as banks, which can slow down transactions and add fees. Without these intermediaries, transactions can be faster and cheaper, making it more convenient for people to send and receive money. Decentralization also provides greater control over personal finances. With Bitcoin, individuals have full ownership of their funds and can make transactions without relying on a bank's approval. This can be especially important in places where people may not trust traditional financial institutions or where governments have strict control over the banking system. Bitcoin relies on cryptographic protocols to secure transactions. This means that complex mathematical algorithms are used to ensure the safety and integrity of each transaction. As a result, it's extremely difficult for anyone to manipulate or counterfeit Bitcoin transactions, making it a secure way to store and transfer value. Additionally, Bitcoin's transaction history is immutable, meaning it cannot be changed or erased. This transparency ensures that all Bitcoin transactions are permanently recorded on a public ledger called the blockchain. This makes it easy to verify transactions and prevents fraudulent activities. Bitcoin is often seen as a store of value similar to gold. This means that people view it as a long-term investment to protect their wealth from inflation or economic instability. The limited supply of Bitcoin, there will only ever be 21 million coins, contributes to its potential as a store of value. Moreover, Bitcoin has gained popularity as a speculative investment, with the potential for substantial returns. Some individuals buy Bitcoin in the hopes that its price will increase over time, allowing them to sell it for a profit. However, it's important to note that Bitcoin's value can be highly volatile, and investing in it carries risks. Bitcoin can provide financial inclusion by making the financial system accessible to the unbanked. In many parts of the world, a significant portion of the population lacks access to traditional banking services. Bitcoin allows them to participate in the global economy and have a secure way to store and transfer money. Furthermore, Bitcoin is used for remittances and cross-border transactions. Migrant workers can send money back to their families in their home countries more efficiently and affordably than with traditional remittance services, which often charge high fees. So if you're enjoying this insightful discussion and want to keep up with the latest updates and videos, subscribe to our channel now. Don't forget to hit the notifications icon so you won't miss any of our future content. Cryptocurrencies have gained immense popularity, but they also come with their fair share of concerns and criticisms. These issues span a range of categories, from economic stability to ethical and environmental concerns. One of the most prominent criticisms of cryptocurrencies is their extreme price fluctuations. Bitcoin, for instance, has witnessed staggering surges and plunges in value, causing uncertainty for investors and making it challenging to use them as stable stores of value. Such volatility can be attributed to a variety of factors, including market sentiment, news events, and the relatively small market size compared to traditional financial assets. This volatility has led to concerns that cryptocurrencies are more akin to speculative investments than dependable currencies. Market manipulation is another issue in this regard. The absence of rigorous regulation in the cryptocurrency market makes it susceptible to price manipulation. Traders with significant holdings can engage in practices like pump and dump schemes, artificially inflating the price before selling off their assets, leaving unsuspecting investors with significant losses. The decentralized nature of cryptocurrencies presents regulatory challenges. This lack of oversight creates opportunities for illegal activities, such as fraud and illicit transactions. Critics argue that cryptocurrencies, especially privacy-focused ones, offer an ideal environment for money laundering, terrorist financing, and other criminal activities. This has put pressure on governments worldwide to establish regulatory frameworks to address these concerns. Additionally, there are concerns about tax evasion. Cryptocurrencies can be used to evade taxes by keeping transactions anonymous, making it difficult for tax authorities to track and collect taxes on these assets. This raises questions about the fairness of the tax system and the potential revenue losses for governments. Cryptocurrencies are also criticized for their significant energy consumption and carbon footprint. Bitcoin, in particular, relies on a process known as proof of work, which demands massive computational power, consuming vast amounts of electricity. This has raised concerns about the environmental impact of cryptocurrency mining. To mitigate these issues, some have proposed alternative consensus mechanisms like proof of stake, which require considerably less energy. Scams and fraudulent activities have plagued the cryptocurrency space since its inception. Ponzi schemes and fraudulent initial coin offerings, ICOs, have left many investors empty-handed. These scams promise high returns but ultimately collapse, causing financial devastation for those involved. Hacks and security breaches are also significant concerns. Cryptocurrency exchanges and wallets have been vulnerable to cyber attacks, resulting in the theft of substantial amounts of digital assets. The lack of traditional financial safeguards, like insurance, leaves victims with little recourse. Bitcoin has been making waves in the global economy. One significant development is its adoption by institutions, which includes corporations and institutional investors. Many big companies have started to invest in Bitcoin, treating it as a store of value and a potential hedge against inflation. Additionally, institutional investors such as hedge funds and asset management firms have shown increasing interest in Bitcoin, integrating it into their investment portfolios. This institutional adoption has boosted Bitcoin's credibility and its role in the financial world. Another aspect of Bitcoin's impact on the global economy relates to the emergence of central bank digital currencies, CBDCs. Some countries are exploring the idea of creating their own digital currencies. These CBDCs could potentially change the way we interact with money and payments, offering more efficient and secure transactions. This development reflects the competition Bitcoin presents to traditional financial systems, forcing them to adapt and modernize. Within traditional financial systems, Bitcoin has presented both challenges and opportunities. The banking industry is grappling with the idea of decentralized currencies, which can disrupt their traditional role as intermediaries in financial transactions. Moreover, the future of cross-border payments may be revolutionized by Bitcoin's borderless nature, reducing the costs and time involved in international transactions. It could also offer financial inclusion to those without access to traditional banking services. Economically, Bitcoin has raised questions about its role as an inflation hedge and its impact on economic stability. Many see Bitcoin as a safeguard against inflation, akin to digital gold, where value can be preserved in times of economic uncertainty. However, its volatile nature also poses risks, as its value can fluctuate dramatically. Central banks must navigate this new landscape and adapt their policies to maintain monetary control. The rise of Bitcoin has spurred discussions about the role of central banks and their influence on the broader economy. It's important to acknowledge the ongoing debate about Bitcoin. This digital currency has sparked discussions worldwide. Bitcoin's true nature is still uncertain. Some see it as a scam, while others view it as a gift. The future of Bitcoin is fascinating and it's continuously changing. To stay updated on such topics, please subscribe to our channel now.